Good morning, everybody. Welcome to the Flow Show. Getting ready to do better with markets yet again. Morning, Kay. How you doing?
Morning, Ryan. Morning, everybody. Yeah, we're ready to rock and roll once more.
Ready to rock and roll. Yeah, we hope we get some rocking and rolling going on. Let's see. We've got some data coming up today that's hopefully will be big for markets and give us some moves. Let's get through some of the other data and headlines first. China has apparently told banks to roll over some local government debts, just part of their smoothing operations there to create less waves on possible debt. So they're just going to knock some of those over. Over in Japan, and for a change, Finance Minister Suzuki has declined to comment on the weak yen factors. It's going to be a first, really, for those guys not to comment on what the yen is doing. Not that it's doing an awful lot at the moment anyway. Coming over to New Zealand, I haven't even got the blooming thing open yet, have I? Oh, behind as always. Give me 2 seconds. I haven't got the calendar open. Where are we? There we go. Cool. I thought I was all ready, and I'm not. Where are we going? There and there, and wallop. There we go. So, what I was going to tell you about was the inflation data out of New Zealand coming in. Its quarterly numbers coming in a bit softer than expected on the quarter, 1.8%. Was expected to jump to 2%, so coming in a little bit softer, though it was a rise. However, the year-on-year number dropping a good chunk to 5.6% lower than expected and last month. That's taken a bit of wind out of hike expectations. Not that they were running too hot anyway, and a lot of the market was looking later in the year anyway. ANZ now see a hike coming in February versus November previously, so they've knocked it back from next month into 2024 based on that data there. Over in Australia, the RBA minutes were out. The usual talk of could they hike, could they hold? They favoured a hold yet again, as we know. No real headlines out of the minutes than what we've already learnt. The only thing was a bit of a rewrite of their thoughts on inflation, saying that the board has a low tolerance for a slower return of inflation to target than currently expected. So just highlighting the fact that inflation is taking a little bit longer to get where they want it to go. And so they're just keeping the comments up that they do have a low tolerance for that slow return, which some in the market have taken as a bit of a hawkish tilt, but it's just, as I say, same sentiment written differently. So a hike for them is still on the table. It's still discussed at meetings, and they just balance it out and continue with holding. But they're keeping one on the table any which way. Over in the UK, we got that, half the employment data, wages mainly. As you can see there, average earnings, take away the bonus, coming in as expected, 7.8%, only a pip down on last month. Average earnings, including bonuses, down to 8.1, so a little bit softer than expected. Still big numbers. We've had DINGRA out, BOE's DINGRA out, saying that average weekly earnings data appear to give a more inflated picture of the wage outlook than other measures. The labour market is really loosening and doesn't see any further wage growth momentum. I don't know if she's right. We've had some big numbers coming into this, obviously, as known, some big one-off factors like public sector pay increases and the like. But this is now 3 months we're seeing these sort of numbers. So when you get a boost from the public sector, they don't tend to last. They tend to drop out. You know, you get that hit in 1 month, maybe 2 months, and then we're over and done with it. So the fact these wages are staying up so high suggests that there is some pay issues that the BOE perhaps need to be worried about. It is coming down, no doubt. It's not coming down very fast. So if that continues to stay around these levels, it is going to become an issue. Now, she may be right that the labour market is really loosening, but we're always a unique situation here in the UK. We could see the market, the jobs market, falling back. That doesn't mean that people are going to take less wage, though. In other countries that may happen, but there will be still people demanding higher wages. Train drivers are not going to halt an end to pay disputes just because the labour market is weaker. It's not going to happen. So there is potential for still a wage inflationary pressure to come, even if the jobs market pulls back. She's not expecting that. I would expect that, and I'll bet you a fiver who's going to be right in the end on that one. Anyway, she also says PPI is very indicative of future CPI inflation. That's the negative year-on-year numbers we've seen in PPI. She thinks that's going to translate into lower numbers for CPI. We shall see. We do get, I think we get inflation data this week, if I recall correctly. Let me double check. I believe so. Yep. Tomorrow we get inflation data and PPI data for the UK. So we'll keep an eye on that. CPI is expected to fall a pip to 6.6%. The core number down 2 pips to 6%. These are numbers for September. What I would advise is the October numbers that we'll get in November, likely potentially going to come lower because the next energy price cut kicks in or kicked in from the beginning of October, and that will feed into prices that we get in November. But for this month, inflation is expected to tip back a bit, but still well above that 2% target. Over in Germany, zoo expectations out, and what you might call a bit of a improvement. Less crappy on the economic sentiment, only down 1.1, very nearly turning positive. That would be a bit of a surprise. Current conditions easing a little bit, only 79.9 negative versus the 80.8 expected, but still worse than last month. So not quite improving there just yet. However, the zoo thinks they may have found a bottom by saying it seems we have passed the lowest point. Yeah, we shall see about that one as well. Over in France, apparently they're ready to accelerate spending cuts to battle their persistent deficits. Again, spending cuts, that's not going to be good potentially for the economy. So we'll see what fires that light among the population. ECB's Lagarde is becoming an oil trader. She says she's now watching oil for inflation risks. Let's hope she does a better job than some in the market. Coming up back to yesterday's data, and we had not a lot really. We had, if I can find it, we had the New York Empire manufacturing coming in, not as soft as expected, but still dropping from the positive 1.9 previously to minus 4.6. The underlying components not really doing an awful lot. New orders went negative at 4.2 versus a positive 5.1. Employment rose to a positive 3.1 from a negative 2.7. Prices paid dipped by 0.3 of a pip to 25.5, and 6 months expectations dropped a tiny bit to 23.1 versus 26.3 previously. So not an awful lot, although employment did pick up there, and prices, inflation costs came down a little bit. So one could put a soft landing slant on that. Fed's Harker, he was out again, repeating that the Fed had likely seen the end of rate hikes, but he did have some comments on the housing market again, saying that current rate environment is draining the housing market of new buyers. And there is ample evidence that many people don't want to sell homes with low mortgage rates. And he's probably right about that as well. There's not going to be many people who want to give up, 2-3% mortgage rates to move home and end up with a 7.5% mortgage rate. So that is going to have a natural effect on the housing market in some way, shape or form, though we're yet to see it in earnest. Over in Canada, we had some data out as well. Manufacturing sales, not a number I keep an awful, I keep a look at regularly, but as this we're getting into the BOC territory and a lot of data this week, it's worth keeping an eye on. Sales were up, not as much as expected on the month in manufacturing. Wholesale sales, again, good positive, not as much as expected, but positive nonetheless. We also got the BOC Business Outlook survey. Future sales rose to 14 from a previous -6. The overall business outlook fell 3.5 versus a prior -2.2. So a little bit mixed on the headlines there. The outlook looking a bit better. Current conditions, we can call it, a little bit negative, worse than the last quarter. These are quarterly numbers, is for Q3. In the details, firms reported that activity has slowed across a broad range of indicators. Their expectations for sales growth, especially sales to domestic customers, continued to moderate. On balance, firms are still planning to make larger and more frequent price increases than they did before the COVID pandemic, but they expect to raise their selling prices at a slower rate. So still inflationary pressures there for the bank to deal with. They also noted in the survey that negative impacts from rising interest rates are spreading. So that's a bit of a counter for the BOC to stay on pause, to let the effects of rate hikes continue to play out. On the jobs front, firms are planning to slow hiring, though few intend to actually lay off workers. Wage growth is still expected to be higher than normal. There we go, the inflation pressure again. On inflation directly, they say inflation expectations remain high, and many firms think inflation will stay above 2% for longer than 3 years. So that's the inflation expectations factor for the BOC to consider. Overall, just taking this as a little snapshot, it shows that hikes are having an effect and are still playing out, which, as I say, that is a tick for the pause side of the trade, but inflation is expected to run higher. Prices charged and input prices still expected to rise, which is something that they might want to keep on top of. So there's a little bit for both sides of the coin there for the pause hike expectations coming into the next BOC. Lastly, and I'm sure you all saw this happenings in Bitcoin yesterday. Absolute mess it was yesterday. There was a headline from Cointelegraph saying that the SEC had approved BlackRock's iShares ETF, and that was a nice $2,000 rally in Bitcoin, only for it all to be denied and actually Cointelegraph to retract. Well, they didn't retract it, they edited their original tweet that gave that news, and they've got in all sorts of trouble since then. And that was a big turnaround in Bitcoin. Absolute mess in that one. Kay, you got anything you want to throw in the mix?
Oh my God, I'm just tired of listening to you already, mate. I mean,
yeah, I thought I'd get it all out of the way.
On a run there. Wow. Well, a couple of things, you know. Of course, we need to look at the situation in the Middle East. Biden is going tomorrow to Israel, and perhaps the market can stay on a bit of hopium scenario until then. Perhaps the Israelis will hold back from moving too harshly into the Gaza and whatever else before his visit. So we definitely have to keep an eye on what's going on there, especially for once wheels are up again, once Biden takes off again. But that's likely for tomorrow then. Yeah, on the other front, just on the Chinese thing, we talked about those Chinese measures seemingly starting to have the investor market not believing in what's going on in China per se, but at least taking the pressure off the CNY, CNH. But the latest measures that they are trying to put in place are not impressing anyone. And we are back onto into that 732. Of course, there's part dollars. We see the US yields tick up again, but we're getting that bit of a zone, 732, 33, which is the top end of the allowed 2% move around the dollar CNY fixing, but it has been relatively respected on the CNH fund as well. So we are into this interesting zone again. Against those measures that they put in place, we have the, what is it, Evergrande issues again with their bond payments. We won't know whether they are going to be paid or not before the end of the day, I guess. For the time being, they have not been paid. So that's one to keep an eye on. In regards to the RBA, I mean, it feels a little bit to me like they you know, when it all started after during the pandemic, they were not going to raise rates for 3 years, and now they are not going to bring them lower for 3 years, and which may be the 3 years maybe last 2 months. You know, I'm not reading too much into this. Yes, the market took advantage of this to ramp mainly Aussie Kiwi higher. We're back close to the 108 magnet level, and that's the biggest result of it. Really, I'm not going to start to buy Aussie just because of the RBA may be wrong again. But anyway, we will see the data, right? And for the rest, not seeing too much of fresh news, you know, that could drive markets right now. The only thing is mainly those US yields that, after all, held pretty well, and I'll show them a little later, and showing the differentials and stuff, which are again moving slowly but surely into the dollar's favor. And that's it. We are having the Canadian CPI out today. That is one that is for sure going to have an impact, because the Bank of Canada is watching this. We should, and they are talking about it. We should watch it. So this is going to be an important one, and perhaps the Canadian CPI. Of course, the US retail sales are going to be monitored, but it may be a bigger mover than the US retail sales, because the Bank of Canada has prepared the terrain for it to be a mover. So that's one which is going possibly to be the bigger mover of the day. So that's the things I'm watching. Of course, the retail sales, and they can move the yields market as well in the States, and those yields, wanting it or not, they continue to move around quite rapidly. Again, we've having since Thursday last Thursday when I was off, those US yields have the US 10s, just as an example, have gone up 20 BPs, which is, again, the market is getting numb to those kind of moves. We as retail traders are, for sure. A lot of people may not even realize what kind of amounts are involved when the US 10s move 20 BPs. Just take it from the Japanese side, who have about $1 trillion worth of those things, and you'll know what it means, a 20 BP move. But anyway, we are not going to react more than what the market is reacting. completely agree, and for sure don't disagree with you, Arnis, saying that the US 10s could be moving up to 5%. We will know as well relatively soon what the TGA refunding needs are going to be for the US Treasury, and in the meantime, the Fed's QT is still zooming in the background, which is de facto going to underpin rates, all else equal in the economy or in the growth sector. So those are the kind of things that I'm watching now. And yeah, on the news front, nothing more, right?
I think the data today is going to be interesting, particularly for dollar CAD. Obviously, mixing between both numbers there, the US retails and the inflation. I keep wanting to be short dollar CAD on the back of the BOC, but I actually think this might be potentially a dip buying opportunity in the loonie. If the CAD data comes in pretty strong and it overplays the retail sales, well, that's if retail sales aren't horrendous. But if they're both decent numbers and dollar CAD moves lower based on the CPI numbers, if they're hot, and they'll need to be much higher than what's expected for the CPI and the core numbers. So if the mood today is a dollar bid, then, if you see the data counter that move, we're still fairly in trading terms a long way from the BOC. It might just be a dip to look at if yield to continue to rise and the dollar remains bid. The only counter to that, I'd say, is that we are seeing these yields rise, but the dollar strength just isn't quite there as it was. Last time 10s were up at this 570 level. That was when euro dollar was hitting fresh lows around 105. Cable was hitting the lows, that sort of thing. We're not doing that this time in this run. Euro dollar still holding well above 105. It's not collapsing back down to these levels. So there's a bit of bit of an unknown in the market still at the moment regarding all this geopolitical stuff. Yields seem to be ignoring it. Currencies not so much perhaps, or there's still a bit of push and pull between the crosses and the yen and the Swiss and everything else, and maybe the majors are just sort of circling around, not really knowing what to do. Biden going over there, we've had Blinken over there. There's definitely efforts being made from a lot of parties to maybe dial down the situation, let Israel do what it wants to do, but maybe limit how much it does in that. There's talk of opening up these corridors and safe zones for the population and whatever. So, if it becomes a scaled down offensive, I think the market's going to stick that in the rearview mirror pretty quickly. And then we move on. But as far as the data is concerned, and just looking at the US side of things, the reaction, if retail sales are strong, i.e. more good data, what is that going to mean for yields? Are we going to attack those highs again, up near the 590s? We're going to get a move up to there. If we get a move up to there, what's it going to do? Is it going to confirm another top up there? Maybe put in a triple top, or are we going to go through and hit 5%? So as much as we all wait for the next piece of data to tell us how the data reacts is going to be key. We saw last week PPI data, saw a little bit of a pop in the dollar, then it got sold off. Even CPI saw a stronger rally in the dollar, got us this move late in the day, up from 5.5s to 5.7s. Then it didn't last on the risk number. So, what's going to happen? Strong data, soft landing, doesn't mean we're going to go high. Is the market going to get a bit more hawkish for the FOMC, or whether it's this one or the next one? So interesting reactions to see, and then we'll see what the dollar's going to do. But as I said, okay, I don't think, we're not out this risk situation. It may be moving to the rearview mirror. It's not there yet. If we look at gold, it's keeping up. and this is now rising as yields are rising. So, you know, what's happening there, mate?
That is your anti-risk. So the negative risk play, right now. That's where the market is going into, and then you have partially the dollar and partially the Swiss. But I think if to make FX move, and don't forget how big the FX market is, right? This is really you need flows, right, to make a market move, and perhaps those flows have not yet hit the market. Perhaps just it's and you know, currencies is not all about yield move. We have been on the yield train for 3 years basically. It's not all about that. Now it's starting to be a growth differential, and that's uncertain right now because the market thinks that that the rate hikes are going to pass through, that CPI in the meantime is okay, holding up sticky, but has come down quite a bit already. Growth may be hit, so there's going to be other subtleties in the FX market. I mean, the thing is, if your US yields go higher, and I'll show the differentials then again, the differentials are not moving a lot. They are moving in favor of the dollar, but not a lot. A lot of the yields in the major sphere, apart from yen and Swiss, they are still pretty much moving together. So that reduces the need for really FX trades by investors or asset managers, and that's why I think we're still in those ranges. The issue, all else equal, if you don't have big shocks in the economy, the issue now will be, I think, going forward, what's going to happen into the end of the year. Because if the Treasury continues to have big funding needs, and Fed doesn't change anything about the QT, I think with even with yields unchanged, we may see. Well, actually, that's going to likely push yields higher a bit, and that may then create those flows that are needed to cover those kind of things. And I'm more thinking about the external dollar debt than really the local US debt, which is horrible right now. But we know that's been horrible for 40 years that I've been in the market. Everybody is still complaining about that, and we're 40 years later, we're still complaining about it, but very little has been done about it. So I mean, it's a horrible situation, but it's something that is very little tradable. I've seen over the course of my career in the market. So yeah, I mean, it comes back from time to time, but then but the external debt in dollars is something that is that may be tradable. And if you start to hear about liquidity issues into the end of the year, the turn, people, instead of borrowing at 5 or 5.25% or above the 5% in the 30 years, they may just decide to buy dollars instead of borrowing up there, in the hope that next year situation in the economy will slow down and the yields come back down, and then they can sell their dollars again and rather go to rather fund it straight away in the market. So that is something to look out to, in my opinion, and that could be a big driver towards the end of the year. That outside of any geopolitical consideration, of course.
Yeah, and that would come particularly in EMs against those selling dollars to stop weakness in their own currencies. So
yeah,
and then to buy them all back again on liquidity problems. But
yeah, that's the thing. They will be selling dollars in their own currency. Some of the countries already doing it. Like for instance, China has been already doing it. But then if you want to stay dollar neutral, you're going to need to have to buy them back against something else, or start to borrow them, and then you have a counter effect. I mean, an intervention is always something very strange as well, because the mechanism to buy dollars versus your own currencies is very different from when you have to sell dollars against your own currency. So and that could create even bigger funding problems down the line. But okay, this is not at the order of the day, but it's something that we can't really completely dismiss, and we are gradually moving closer to the end of the year. And if those kind of problems would start to pop up, then and if the geopolitical situation is still a mess, then I think we've got to be very careful with the dollar into the end of the year. But again, not something we are going to look at today. Today it's retail sales and Canadian CPI.
Yeah.
And listening to what's going on the geopolitical front. Right?
Yeah, and right, so I'm going to look at pound Swiss for Arnis, as we were looking at last week. Yeah, a hefty breakdown. It's gone, as you say, down on multi-week support. We were looking at this, as I say, last week. Hefty levels down here right now. It's a break, but I'm loath to believe it's a full-on real break because of the Swiss factor in the geopolitical risk. So technically, what we haven't seen yet is a confirmation. It's down, it's holding down, it's holding below some of these past spikes lower. But until we get a test and hold of that, I won't really believe it's a real break just yet. If we get positive headlines out of Israel and that sort of thing from Biden or whatever, then boom, we're likely to be back above it again, and then 10 minutes later we'll see it coming in as support. So if you did catch the break on this, well done. This is where you need to manage your trade against. Back above there, we're potentially shorts are looking in trouble. I hope none of you guys are long down here, like long from above the level, and are sitting in it hoping that we get back up again. I warned about this last week, that if we got a break, then it could be a bit significant. But for the moment, where can it go? I think the headlines are going to drive it, really. If there's more bad news from the Middle East, then this is going to be heading lower, as are pretty much all the Swiss pairs. Same boat as they have been for the last few days. So yeah, this one is more trading on the geopolitical side of things than the fundamentals. But you've got to keep an eye on that for the quid. The quid is looking a little bit weaker today, versus something like the euro. You can see that in euro sterling. We're up testing the highs there. As you can see, euro dollar still holding up. Cable doing a little bit coming off there, maybe on the back of that softer wage numbers, although they're not still not soft in reality. Euro sterling, it's nudging up back above the zone. It's been faffing around in there for the last couple of days. Same old, same old. Can we get a move to 87? Can we get a move above 87, 15, 20? Otherwise, no. If not, then we're sticking in this sideways action that we've seen. Couldn't quite get that test of 86, 10, 86. I was waiting for. We had this short-term downtrend broken, held. I wouldn't trust this line really to trade, but it's something just to keep an eye on, very short-term in the meantime. And as mentioned, Aussie Kiwi getting up towards, it's like a boomerang, this thing, and this 108 area. We've pointed it out plenty of times before. Today, it is pretty much more based on Aussie strength. When it was going down, it was based on a bit of Kiwi strength and a bit of Aussie weakness. But Aussie doing its little bouncy thing as well down here, keeping that short-term gain, whereas you've seen others coming off. Kiwi looks interesting because it's bouncing along the floor. We saw this come down, it stopped falling, but the trend is still, you could say it's, we're not broken the trend yet. These levels down here, 57, 60, 70, are going to be important. If we break under 60s, then maybe we got a bit of a break happening. Got a couple of levels to watch on the way down. If they don't hold it, we may be on for a move down to 55s. So as I said earlier, yields are US yields are rising. The dollar isn't really looking stronger for that move. But if that retail sales comes in strong, then that's maybe when the dollar strength kicks in on the back of yields as well. And it's a bit of a double whammy. So be careful of if you're short dollars in some of these pairs like I am versus the euro, because if it goes big, then we could be on for another move and a bit of a break of some lows. What have you got there? 2 entries on this. 110. Is that's shorts? I assume you're short up there at those levels. Yeah, on pound sterling. Yeah, cool. Very good, mate. Very good. You've got your stop loss at break even. Good. Free trader. Have you taken some profit? I hope you've taken some profit already. And you know the line where the trade may turn. So yeah, take some profit on that and see how far you can push it. Keep your protection in behind you. Okay, you want to look at yields in a bit more detail. So I shall throw across the baton to you, mate. All yours.
Okay. All right, let me just look at the 10s first. Here, as I said before I left, there were 2 levels that I was watching. So this was just before I left, right here. And we're on a bit of support, a bit of and the 460 here was a trend line. And then I said, well, just keep a close eye on the 450 as well, because it was the springboard for that last, well, for now, latest move higher, I should say. So we went below, and then CPI came out, and what else not? And we rebounded pretty strongly, and now we are back above those trend lines. And if you look at the daily here, so we're back above this trend line as well. The 450s are here. This is really your zone where it should hold, and as long as it holds, this could actually press on again. There are some more auctions this week, but I'm not sure whether we have a 10-year. I know there's a 5-year, there's a 20-year there, there's a 5-year there. We have no 10s this week, but towards the end of October, this is going to lightly heat up again when the U.S. Treasury will come out with their plans. If we draw fib extension, okay. Yeah, right. All right. Okay. Yeah, I see what you mean. All right. So this is for the US 10s. We can do the US 30 will be much more interesting around the 5% again. You know, we had this little bit of a shoot up in the 30s, but if we get back above 5%, that's where I reckon we are going to hear all those calls about probably liquidity and stuff starting to pop up again, and we'll have to be careful. Now on the shorter term stuff, and you know, I'm always looking at what the euro dollar does compared to, or what cable are doing compared to the differentials, and we've seen these differentials. So the lower it goes, the wider they go. Okay, it's the inverted. It's a differential between EU and US. So this is inverted. You see minus 1.926%, but we always express it in basis points. So we are at 193 basis points, give and take. That's a bit lower, and the euro dollar is just lower, but we are not breaking fresh ground. As I've been already repeatedly saying, it's not a perfect overlay, but it's close. But this is keeping the euro dollar, unless it starts to reverse higher, that means tighter, keeping the euro dollar from really bouncing too much. It's keeping it in its range right now, but we will need to see widening here for the euro dollar to really fall out of bed again. For now, it's not happening, and we've seen after the zoo. I'm going to have a quick look on the euro crosses as well today. We've seen after the zoo that the euro crosses are pushing higher a bit, and that's also holding euro dollar from coming down. I think those 15, 20 points move up on the euro dollar post the zoo have more to do with what's happening in the euro crosses than really euro dollar as such. So, but that is one to keep an eye on. If you start to get tighter than 180 basis points, that's probably confirming around 175, 176. That's probably where your euro dollar has a chance to break above its channel. That's very close, but this is the level that I was watching last week, the 106.35.50 zone. That is probably going to be your zone here on the differentials. If we start to get back wider than 200 basis points, that's likely going to put pressure back on your on the lows that we saw in prior weeks, in somewhere in the 104s. Okay, that for the euro dollar and differential correlation. If you look at the sterling, that's looking a little iffy here, and that is looking pretty wide compared to where we were used to trade it when the sterling was also trading more in the 125, 6, 7s, 130s. You know, now we're trading below this zone around the 123, 23 and a half, and this is really typical lately of such a move. So keep an eye on what's happening here, because we are not too far from prior lows, and also the reason why cable has been acting a bit weaker, and you see it also on the crosses like euro sterling higher, is because we are back into negative territory. We've been hovering for a fair part of 2023, and when I was saying I mean that sterling is still looking positive, that is when the cable was trading better, when the sterling crosses were trading better, euro sterling yen at its highs, euro sterling at its lows, and since we've really dropped back below, sterling is acting weaker versus also on the cross side. So it's not only cable that you can measure for these from this picture, but also what's happening on the cross side in the sterling. By the way, I'm looking at the EU2s and the sterling 5s. Okay, I don't have a specific reason for that, but the market is, this is just what the market is watching. And if you want to be clever and watch something else, you are going to not be looking at what the market is looking at. And if it's always better to look at what the market is looking at, right? And I don't have the specific reason for that. I perhaps should ask some bond traders or people who do proprietary trading also why that is. But anyway, if you want to reproduce it, look at what's happening on the EU2s and on the something come out there, and on the sterling 5s. Okay, so and then overlay this with the cable, and you will see what I mean. This is pretty much what's going on in the cable as well. Okay, so we've had this yesterday little tryout back to above 122, but we couldn't reach the 50% of the latest move. So this is now seemingly a pretty, what's happening there? Is something happening? I see dollar yen coming off quite sharply.
I can't see anything. Hang on. Let's have a look. What's going on?
I don't know if anyone has any more info.
I've not got my squawk on, so I can't hear anything.
No, I don't. The squawk doesn't say anything. I don't know. Something. I don't know what happened there. Anyway,
so not really.
Yeah, I mean it's moving quite a bit there.
Yen led. What's happening in gold? Gold not doing anything. Ticking up a bit. Swissy.
Yeah, but I mean we know about Vladimir Putin and visiting whatever. I mean no. I don't know.
Don't know.
BOJ raising, here we go. BOJ to discuss raising price view to 2% or above. Okay.
We knew that anyway.
Yeah, we knew that. I mean, the market is okay. Thanks, guys. Did we really go down to 148.75?
Bloody hell. I wish I'd seen that.
Yeah, me too.
That's ridiculous.
I mean, what the heck? Yeah, wow. That's a big move.
Oh, I wish I'd seen that at the time. I would have smacked that. Smacked the living daylights out of that one.
Look at this. This is ridiculous. What a ridiculous move.
When do we have that headline? We had that headline. We had it on here on the show a week ago.
Yeah.
I can tell you when it was.
No, I mean that thing is not new at all. Wow.
Tuesday the 10th.
Yeah, I mean.
We don't had that.
That's come on. All right, so this is an opportunity miss then. Okay, and see where the 4-hour cloud lies, because this has been playing a role. If you look at your chart, this has been playing a role over the past moves in dollar yen. Okay, perhaps not in this big one, but look where the 4-hour cloud lies, and that's around that 148.70. Okay, so I mean, I was just going to say 148.70, 148.5 is going to be a bit of a level to watch. Oh dear, that's an opportunity missed. I'm nearly inclined to buy it.
Yeah, no, yeah, I'm kicking myself. Oh, I don't know.
Right. Okay. So yeah, I was looking at the. I was going to quickly look at the euro process. Forget about the euro yen. But no, I mean, look at what's happening, especially in stuff like euro kiwi. So we had that bit of a kiwi move overnight, and look what it did to the euro kiwi. That's gone back up to the break level, the break line here of this trend higher. So keep a close eye on what's going on in the euro kiwi, just above 170, just above 179. 179.30-ish. Also, euro sterling. I'm really kicking myself for not having seen this move on the down. Euro sterling. So Ryan already showed those levels, but keep an eye on this trend line here. This has been behaving pretty nicely. Okay. So any move down to 86.30, 86.40, I'm expecting to find a few buyers there. Yeah, so as I said, the sterling also on the crosses is behaving a bit weaker, and we can see it here on this euro sterling as well. So I'm going to keep an eye on what's happening anywhere in the 86.25 to 86.35-40 zone. If we get a revisit there, it could be a nice area to start looking at something in the euro sterling. On this is really ridiculous. Okay. Right. Let's put that among the missed opportunities.
That was an open goal, mate. That was an open goal, 2 yards out.
Absolutely. But anyway, I mean, maybe they're going for another round, and then we can pick up some. But yeah, I mean, this is really not a warranted move on the back of all this news. Okay. So that, and I was going to show another one, and that is Euro Canada. Euro Canada has been in the range here, and that's going to be important for this afternoon, right? The Euro crosses are a bit on the up right now, and this is going to be important for the afternoon. Euro Canada 143.25, 143.85. We are a little above now, and I was going to say, if you look at oils, if you look at gas, and when the Canadian CPI is going to come out, this is going to be a zone here around this 144 1530 zone, stretch it to 144.5 maybe, to keep a close eye on what's going on in the euro CAD, because the euro on its own, I know the euro crosses are going a bit higher, and perhaps risk is also pushing it up a little bit if oil would come back down, if the Israeli situation, etc., is evolving positively, which for a humanitarian reason, of course, we hope. But if it's evolving a little bit, I'm not sure if the euro on its own will have enough strength to regain much higher levels than where we are here. So just know that I'm going to be keeping an eye on this euro CAD around here. Really, that's it for me. The dollar CAD is less. We are again trying to decide what's going on with this block here, with this range here. But it just may be starting to form a head and shoulders here. But the neckline is not really very clear and is waiting much lower, unless you take this 135.70 as a barometer. So you could say that we are around where the underside of this block is. The top side is again 95 figure 137. Keep an eye on what's happening at 135.70 if we get a double whammy, weaker retail sales on the dollar and stronger CPI on the Canadian dollar, for instance. Gold, silver showed it yesterday. They're pretty stable right now, but they're keeping their levels. So that means that the market is still taking into account what could happen in geopolitics, and especially in the Gaza-Israel region. So keep an eye on that one. 1910, 19 the figure, 1930, and then if you want to have an extra line of measurement, 1935, stretch it to 1940 on gold. And with that, I give it back to you, Mr. Ryan.
Thank you, mate. Well, one thing from that dollar-yen move, I think we can ascertain that until the market saw what the reason was, there's still some nerves in there. If we see sudden drops in the yen, people thinking there might be something afoot from the MOF, and hit the sell button first, ask questions later. But anyway, bit of an overreaction there. Chris, well done, mate. You owe us 4 pints, dear. Well, at this rate, you know, as a whole brewery, but more happy that you made money on that move and managed to profit from it. So well done being the right way on that one, mate. Right. Well, that was an interesting show, wasn't it? We shall leave it there. Watch that data later. Trade safe as always. Thank you for coming and supporting us here at the Flow Show. Thank you to Kay for all his input as usual as well. Have a great day, everybody. See you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.